Welcome to the programme, everybody. It is Wednesday, the 12th of March. We are hearing from Ursula von der Leyen, the European Commission President, as she speaks on tariffs from Strasbourg. Let's listen in.
We take today are strong but proportionate. As the United States are applying tariffs worth $28 billion, we are responding with countermeasures worth 26 billion euros. This matches the economic scope of the tariffs of the United States. Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs. We are ready to engage in a meaningful dialogue. I have entrusted Trade Commissioner Maroš Šefčovič to resume his talks to explore better solutions with the United States.
Thank you very much, Madam President. Let me also start by echoing the sentiment of deep regret. Today's tariffs from the United States take us in a wrong direction, and the reason is manifold. The EU-US trade partnership is well-balanced and highly profitable for both sides. It's the biggest trade relationship in the world. On steel and aluminium particularly, we share some of the challenges, for instance, global overcapacities driven by non-market practices. And the EU here is clearly part of the solution, not the problem. Last month, during my visit to Washington to raise these points, it was indeed clear that the EU is not the problem, making today's measures even more unjustified. I argued to avoid the unnecessary burden of measures and countermeasures, but you need a partner for that. You need both hands to clap. The US administration has opted to pursue a harmful course of unjustified tariffs, leaving us with no choice but to respond, and that's exactly what we are doing. First, as of April, we will automatically reinstate our current suspended rebalancing measures from 2018 and 2020, effectively targeting 4.5 billion euros worth of US goods exported to us. And second, the Commission is taking decisive steps towards the package of additional countermeasures applying to 18 billion euros of US exports to the EU. Over the next 2 weeks, we will consult with the key stakeholders to help us shape this new package. The objective is to counterbalance the increased trade value affected by the US tariffs while minimizing the impact on European businesses and consumers. But the disruption caused by tariffs is avoidable if the US administration accepts our extended hand and works with us to strike a deal. So under the President's leadership, I'm ready to negotiate, and we are ready to make it happen. Thank you.
All right. Thank you.
Sorry about the brief delay there. That, of course, was Maroš Šefčovič, the Executive Vice President of the European Commission, following Commission President Ursula von der Leyen, laying out the countermeasures that the EU is now going to put in place. They are designed to match the scope of the US tariffs that have been put in place. They will be in place by April the 13th. So here we are, another day in which tariffs are proving to be the focus of attention. We are watching Anna very carefully how this is going to unfold. The lesson maybe from Canada is that if you respond, Trump will double down. We will wait and see how this unfolds.
Yeah, absolutely. An interesting detail there from Šefčovič talking about how they do want dialogue, they are ready to negotiate, so trying to get the Americans to the table on this. But of course, we know that other tariffs are looming early in April, and so, you know, what are the chances of that happening in the very short term? Interesting, the priorities of Europe here, they want to match to some degree what the US is doing in the sense of the value here, which is 4 times as large as the items that were targeted in the first Trump administration, of course. But they want to minimise the impact on consumers, and so they will spend the next couple of weeks, he said, talking to stakeholders and trying to narrow down exactly what it is that Europe retaliates with, because we have heard that they want to restore some of the 2018-2020 countermeasures, but we don't know exactly how that will be done up to this point.
If you look at the trade relationship from just 2024, the last year between the EU and the US, a lot of it is concentrated in energy. Of course, we know a lot of the US picked up in terms of exports off of the back of the energy crisis in Europe, replacing a lot of the supply from Russia. We know that it's pharmaceutical materials. We also know it's car parts and auto parts as well. This is a common theme we're seeing from China, from Canada, from Mexico. I wonder how much of that is reflected in today's trade.
I think there's a couple of things that I would flag, one of which is the Chinese are telling Walmarts, don't expect us to take the hit, which I think is really fascinating and probably speaks maybe to the CPI print we're going to get a little bit later on. Yeah. The expectation is that if the Chinese take the hit, then that inflation number could be lower. The other thing is the Irish Taoiseach's going to be at the White House today, the Irish Prime Minister. He could be in for a really bumpy ride.
Services trade is not beyond the realms of possibility to get a mention at that kind of confrontation.
Absolutely. Let's bring it right back to the markets here, because futures are higher, at least that we're seeing across the board this morning, after a lot of volatility, a lot of jitters baked into this market, not necessarily about the tariffs, but whether or not the economic resilience, the exceptionalism of America is enough to counter some of these reciprocal tariffs. It's fascinating that you're not starting to see Wall Street catch up here. JP Morgan, Citi, HSBC, RBC cutting price targets, some of them downgrading altogether. Does the market listen? Are they late to the game?
I think it's interesting that we're creating this narrative that markets are bouncing on Trump's comments, his reassurances around the economy, when actually what he also said is markets will go up, markets will go down, and we need to reinvent the US economy, which sounds like he's channeling that same transitionary, there'll be turbulence vibe.
He also said there's going to be higher tariffs. Potentially they could be even higher tariffs than we've got now. He basically said, I'm not backing down. This was a message directly to Wall Street and to US business. This morning, I read that headline first thing this morning. It felt once again like maybe we in the media trying to kind of pin a narrative on a market move that just looks like a kind of bit of a mare move this morning, a kind of catch up, catch your breath kind of a move.
Yes.
And then let's see what happens next kind of a move.
And talking of catching your breath, the tariff story and concerns around US growth weighing on sentiment, but developments around Ukraine for a brief period yesterday, sort of late, very late in the European day, we saw a lift in sentiment, lift in the euro certainly, and EMFX around the Ukraine story.
Yeah, so let's talk a little bit about what we have got. So it looks after 8 hours of talks in Saudi Arabia that we do have a 30-day peace deal. This will include potentially prisoner swaps. It allows access potentially to this mineral deal that the US is so keen to push forward with. We now see Winkoff going to Moscow, the Middle East envoy from the United States, and I just wonder whether this is kind of the critical moment. The expectation, certainly the story yesterday, was that Russia is going to pursue a maximalist approach to this, i.e. a series of demands that Europe, the United States, Ukraine will not be able to accept.
Yeah.
So you wonder whether or not actually Ukraine has said, you know what, let's put it in Moscow's court and see what happens, and in the meantime we can take intelligence and we can take weapons and maybe change the situation on the battlefield as well.
And I believe in the last hour we had already heard from Lavrov as well, talking about the fact that NATO troops, even European troops under any banner in Ukraine, is a non-starter. He had already kind of come out with those comments. The U.S. blueprint, apparently, Zelensky saying, is due to have Russia, or at least they're going to ask Russia to halt things like aerial attacks with missiles, bombs and explosive-laden drones.
Yes, and so some of the detail, we wait to get that, and we'll definitely wait to see how Putin responds here, because by some definition, what we've seen here is two people on the same side of a conflict come together and say, we'd like to end this way. And now you take it to the other side. There's no guarantee that the other side says yes. So, what have we really achieved? We'll wait and see if this can actually deliver something.
But the whole Trump premise has been that you have to accept that a peace deal is something that you want. If you don't accept that, then the game changes and we respond differently. That's the lesson we learn from Zelensky's interactions with Trump. Do we get a similar story when it comes to what we're going to see from Moscow? Let's talk about what we've got coming up on the show. Amanda van Dyke, Critical Minerals Hub co-founder, is going to join us. Just how many critical minerals are there in Ukraine? Matthias, Berenberg head of investments and CIO for Equities, is going to be joining us on what we're seeing in terms of the market picture. Plus, Steve Hare, the Sage Group's CEO, is out with a survey. He's out with a survey on how small businesses are responding in the UK to the uncertainty that we are seeing. This, of course, follows what we saw yesterday with the NFIB survey out of the United States, which flagged rising prices and falling confidence amongst US small businesses, Kriti.
And we're going to get another data set later today. Of course, the big headline number is US CPI coming at 12:30 p.m. UK time. But before that, in about, I want to say, an hour and maybe less than 2 hours-ish, ECB's Christine Lagarde is going to be speaking. We just heard from Ursula von der Leyen. The ECB, Christine Lagarde, has notably not spoken about what the monetary policy role is in defense spending in kind of this revamp of Europe. Does she change her tune today? Now, of course, I mentioned the US CPI, but right after that, we get a Bank of Canada decision at 1:45 p.m. UK time. And this is going to be crucial because do we get, I should say, an insurance type of rate cut given some of this tariff story? Do we see the monetary policy respond on that front? And then, of course, later, the Irish Premier set to meet with Donald Trump.
It's going to be an interesting conversation. We'll see what happens in the White House a little bit later on.
Tax.
Yes. I have to say, though, that obviously St. Patrick's Day isn't today. It is on Monday, so this is a little early. We have that meeting taking place. What else do you need to know this Wednesday morning? European defence companies firmly in focus this morning. Leonardo last night upgrading its forecast. The Italian company now saying it expects 118 billion euros of orders over the next 5 years. This as Europe rearms. In Germany this morning, Rheinmetall has told investors that it sees sales up 25 to 30% this year alone, but is expecting an operating margin of 15.5%. That looks a little lower than analysts had anticipated. Let's see how the stock responds to that. And the results are in from Greenland, where voters have thrown their weight behind a slower approach to independence. In the Arctic islands, unusually closely watched election, the socially liberal Democrat IT party emerged as the surprise winner in a vote overshadowed, of course, by Donald Trump's plans for a takeover. Despite the global attention, a lawmaker for the party telling Bloomberg that Greenlanders are mostly focused on everyday issues like education and pensions, the normal things. And staying with politics, Portugal's parliament has toppled the prime minister. The centre-right minority government has been dropped in a confidence vote. This is now likely leading to a third snap election in just over 3 years. Portugal's premier requested the confidence vote last week, saying he wanted to clarify whether his government had, quote, all the conditions to carry out its programme. The Socialists and the far-right Chega party both voted against the government. Another election in Portugal.
I thought we were through all of the political headwinds in 2020. Weren't they all supposed to happen in 2024? Portugal didn't get the memo. But it's been having a few of them, hasn't it? And this is the third in a series.
It was like either 2024 or 2027, right? That was where we were supposed to get a break, and we didn't quite get that. But it's the same dynamics, right? It's the same story of deficits, overextended governments, and then it's, of course, the rise of the far right. You look at the coalition; they're not able to get the support on the far right within Portugal as well. Where have we heard this before? France, Germany, Italy, you name it.
What does this do to plans around defence spending? They had some. And what does it do to asset sales, all kinds of things? TAP on pause, probably. Coming up on the programme, we've been talking a lot about some of the big macro themes around the market, unapologetically, because they are big news. But we also have some really interesting corporate news, and not a lot of it looks good this morning. So Puma shares indicated lower this morning on TradeGate as it forecasts another slow year of growth due to global trade tariffs, currency volatility and geopolitical tensions. More on that and the other stocks to watch at the open. We'll keep an eye on Inditex with that consumer in mind as well. Plus, President Christine Lagarde is set to give her annual speech at the ECB and its Watchers event in Frankfurt. So the ECB president will be speaking. We'll bring you that address a little bit later in the programme. Up next, we'll be joined by Stear, head of developed markets research at Amundi. Lots to talk about when it comes to the corporate earnings story, how it is developing as tariff threats are present or loom on the horizon. If you have any questions, if you want to get involved in any of these conversations, please do. IB plus BBTV Go, that is the function to use on your Bloomberg terminal. This is Bloomberg.
"42 minutes to the market open this Wednesday morning." 42 minutes is a long time at the moment. In this kind of world that we live in, anything could happen in the next 42 minutes. We've certainly had a bumpy last 24 hours. President Trump threatening to double tariffs on Canadian steel. I think he actually did at one point, and then reduce them quite quickly. Apparently there's a meeting taking place today between Canada and the United States that may put things back on a more even keel. Valerie's trying to track these markets and the reaction that we are seeing. Good morning. What are you seeing right now?
Yeah, it's a hard job these days to track these markets. What a swing in the S&P 500 yesterday. After Trump walked back those tariff threats on Canada, we saw a near 2% rise in 2 hours in the S&P 500 into the close. Yes, we did close lower, just shy of correction territory, Guy. But if you need an excuse to buy the dip, I'll give you one of them in my next chart. The RSI indicator, the relative strength index for the S&P 500, is showing that we're in oversold territory. Not only that, the worst oversold territory since 2022. If you flip on, I can just show you this chart here. Here we go. It's the lowest in the oversold territory since 2022. So maybe this is a dip to buy if you want to. This is a good excuse here if you want to. Maybe we'll take our eyes off the tariff tit for tat, off the equity volatility for now. We've got to focus on U.S. CPI dropping an hour earlier than normal at 12:30 UK London time. The focus will be on the core CPI month-on-month print after we got an upside reading in the January figure of 0.4%. Will we see it retrace to 0.3? That's the expectation for Wall Street this morning.
Looking forward to that data a little earlier than anticipated. As you say, Valerie, that CPI print could be one of the key pieces of data we're going to watch out for. So do you buy a dip? Which dip do you buy? Guy Stear, Head of Developed Market Research at Amundi, joining us around the table this morning. Good morning.
Good morning, Guy.
Feeling like buying a dip?
Well, yeah, I think there's lots of things which, as Valerie mentioned, there's lots of things which have been absolutely extraordinary moves. I mean, I think one area which I think some momentum trades are interesting, but there's also some reversal trades. One thing I think is interesting at the moment is some parts of European fixed income markets, because we'd sold off so much in terms of the bund. We had one move which was the biggest single-day sell-off in 35 years. And then, since then, we've seen a little bit of a recovery because people have said, really, should it really have gone so far? So I think that's one kind of move. I think in the U.S. equity markets, though, we really have to wait and see how the economy is going to unfold. And it's not just about tariffs. It's really about consumer spending. I think you started with, in your earlier segment, with the Puma figures, which I think are indicative of one issue, which is the consumer going to spend in this kind of very chaotic, uncertain environment?
So okay, let's just kind of get an idea of the questions you need answers to before you make decisions. So the consumer is one of them. Is inflation another one? Kind of what are the key things that you need greater certainty on before you're willing to dip your toe back in and think about maybe making some more medium-term moves?
Well, I think the first thing in the U.S. is you'd really like to get a sense of what policy is going to be in the medium term, and I'm not sure we're ever
this is by next week, yeah, we're talking about.
Exactly. I'm not sure we're ever going to get that. So I think we're going to have to live with a level of uncertainty, and so I think that's one thing that we're going to have to try and get used to, and we're going to have to see how people's consumption patterns shake out and people's investment patterns shake out. And I'm not even sure that we're going to get a full answer to that in terms of Q1 or whether it's going to be a longer-term question. But one thing I would be very interested in knowing is what are the Q1 GDP figures in the U.S. going to look like? And we're going to have to wait a bit for that. Yeah. But that's going to give us some indicator of sort of the animal spirits in the medium term in the U.S. The second thing in Europe that I'd like to know is whether the commitment to defense spending is going to be generalized and big and consistent. And also, where's the money going to be spent? At the moment, Europe is spending about 60% of its defense budgets in the U.S. Once you add on tariffs, that may change. And I think that the medium-term story in Europe could be bigger defense spending becomes a catalyst to a more generalized change in terms of the way Europe works. Yeah. And if we get higher levels of labor productivity over the medium term, that would be great. So it could be a boon in terms of Europe. And certainly European stock markets kind of want to think that at the moment.
OK, well, I'll come to the European side of this, but keeping an eye on the consumer, and I suppose this is global. I'm looking at the numbers. You mentioned Puma and the numbers there. I'm looking at the numbers out of Inditex here. Sales at constant currency basis, 5 weeks to March the 10th. So this is very up to the minute. Down. They grew 4%, but that's much less than the 10.5% they were running at in 2024. And so that seems to be the message that's going to dominate this earnings release, the fact that sales are slowing into the new year. And this seems to go hand in hand with what we've heard from H&M, what we've heard from Uniqlo. As we wait for clarity, we might not get any, as you say, on all kinds of policies at the White House. Does the consumer globally retrench?
Well, I think that's the beginning of what we're seeing at the moment. I mean, that's going to be really interesting in the Q1 numbers that we get. So with the earnings season starting in April, I think the real focus should be on consumer businesses and not just big ticket items. It can also be smaller businesses, both in the US and in Europe. Because in the US, certainly that's where the consumer there's been a little bit of an inflection point in terms of the consumer, as you mentioned with those figures. And the revenue declines will translate into bigger bottom. So the top line declines will translate into bigger bottom line declines, because we're not only getting the sort of the effect of fewer sales over fixed costs, but also the cost base is going up, and people will expect the cost base to go up. So I think that's a bit of a squeeze, and that's one of the reasons why maybe you should be cautious about buying the dip in terms of the US equity market.
So we watch the consumer globally. You said interesting things about Europe, and you want to see how that defence spend comes through. What's the strategy on Europe then? Because some of the bigger names in Europe have that global exposure, which you might not want right now. So are you looking at sort of mid-caps in Europe? Is that an opportunity?
Well, mid-caps are still pretty attractively valued. I think other things to look at in Europe are domestically focused businesses. So, for example, financials still trade at very attractive price-to-book levels. In a rising interest rate environment, you can imagine that the earnings are going up. Also, with stronger growth in Europe, the cost of risk should probably not be an issue going forward, even though tariffs create a lot of volatility. So there are pockets of the European markets, and I think that's one of them, which is interesting. Also, if we're going into a world where people are going to do less trade, so there's going to be more production domestically, and this is a kind of global theme. What that means is that there's going to be more opportunities for building materials, basic materials, early cyclicals in a lot of markets, and I think that's true for Europe as well.
That sort of reshoring thing, yeah.
Can we talk about the monetary policy piece of this equation as well? We're expecting to hear from Christine Lagarde in just over an hour, and right on the back and the heels of Ursula von der Leyen this morning as well. Why is the ECB so set on cutting rates when tariffs and a fiscal boom from Germany and others are both inflationary?
Yeah, because the fiscal boom from Germany may be inflationary in the medium term, but infrastructure spending takes a long time to put in place. So that's kind of a 2026-27 issue for growth. And defense spending, we have the announcements, or we have the beginning of the announcements, let's say, but we still need to see where the money is going to be spent, how much money will be spent, and when the money will be spent. So these are medium-term issues. And you're right, tariffs are potentially inflationary. But what we're also seeing in terms of the European growth figures is that growth is weak this year. So we think that European growth 2025, probably around 0.7%. It would argue in favor of a lot of flexibility and a lot of room for the central bank to keep going in terms of rate cuts.
Very quickly, putting you on the spot, what's neutral for the ECB?
So we think they're going to 175. If you want to talk about the neutral rate in the medium term, it depends very much on growth. But we think they're going to 175 by the middle of this year.
All right. Guy Stear, head of developed markets research at Amundi. We'll see if the ECB does ultimately go to 175. But I think that's the question I keep wondering. Everything is pointing to inflation. Guy was talking there about the medium term there.
Yep.
What is the medium term? Is that after the next 12 months? Does that factor does that factor in the delay in terms of the transmission mechanism? I don't know.
It's also the markets are playing a part in this, in some ways setting the weather. Guy was talking about the big move we've seen in bunds. What is happening within the bond market also is a factor in terms of how companies are going to borrow going forward. Remember, most companies borrow a kind of 7 to 10, 5, 7, 10. It's that kind of middle portion. And that's where we're seeing quite a big move in terms of the bond markets.
Certainly something we're going to be keeping an eye on. The geopolitics are just another added factor. We didn't even get to Guy when it comes to the other guy, both guys. When it comes to two guys, when it comes to, of course, the peace dividend as well in Ukraine. Coming up, we're going to dive into the details on that conversation. Amanda Van Dyke, managing director and co-founder of the Critical Minerals Hub, will be joining us to dive into the details. Stick with us. This is Bloomberg.
Welcome to the programme, everybody. This is the opening trade. The European futures picture for Europe looks like a little bit of respite from the recent selling. Euro Stoxx 50 futures are up 0.8%. Is this pricing in the Ukraine optimism, such as it is, waiting to hear from Vladimir Putin, president of Russia, and what he thinks about the deal done in Saudi Arabia? We have a little bit of tariff relief, perhaps, or a little bit of US economic gloom relief in the shape of the president of the United States saying he doesn't see a recession coming, but also saying he accepts there's going to be ups and downs in stock markets. So we'll see where that one takes us. Net, we are more positive at the start of trade, and despite some of the disappointing earnings. So we'll see how long it lasts. Let's have a look at the bond markets. We've had a collapse of the government in Portugal. That doesn't seem to have done too much to the bond market because its bond market is moving kind of lockstep with other European bond markets. We see a little bit of buying and those yields coming down just a touch here in the European session.
We'll see how much of that changes, as you mentioned, with the one eye on the geopolitics. Let's go there next. Ukraine has accepted a U.S. proposal for a 30-day truce with Russia in exchange for a lift on its military aid freeze. Now, President Vladimir Zelensky says the next step is for the United States to get Russia to agree to the terms.
Ukraine
accepts this proposal. We consider it positive. We are ready to take such a step, and the United States of America must convince Russia to do the same. That is, we agree, and if the Russians agree, silence will take effect at that very moment.
Meanwhile, U.S. Secretary of State Marco Rubio says he'll take the offer to Russia, saying, quote, the ball is now in their court. Let's get into the details. Joining us now for more, Alex Kokhtarov, Bloomberg's geoeconomics analyst for Russia, Eastern Europe, and Central Asia. Alex, your initial take on the developments of the last 24 hours. How believable is this 30-day truce?
This is obviously a positive development because we've seen that the talks between Ukraine and US have been quite challenging in the previous weeks. So the fact that both Kyiv and Washington were able to agree on this is definitely a positive development. The big question is now whether Russia will agree to this, and short answer is we don't know. The biggest impediment to this will probably be the fact that Ukrainian troops are still present in Russian territory, and this will probably be not acceptable to Vladimir Putin. We've seen that the Russian forces have been advancing in Kursk region in southwestern Russia, the area in which they entered back in August last year, but the Ukrainians are still there. Unless Ukrainians are dislodged from Kursk, I think that Putin is likely to be hesitant on agreeing on this truce.
Alex, if we see Putin being hesitant and he doesn't accept the deal, is the expectation that the US will flood Ukraine with arms to support its efforts? How does it change the situation on the ground if a deal is not done?
It's going to be obviously positive for Ukraine because Ukraine will have sufficient stocks of weapons and ammunition in case if either the truce breaks down or is not extended after the initial 30 days. So having those weapons to arrive in Ukraine would be positive for the military capabilities of Ukrainian forces to be prepared for any resumption of fighting along the front line or for the resumption of Russian strikes on Ukrainian cities. And particularly, the availability of air defense weapons will be crucial for Ukraine.
Alex, thank you very much. We'll see how Russia and the Kremlin responds. Of course, there are plenty of Russian troops on Ukrainian soil right now, but the Ukrainians have agreed so far. Let's see how it develops. Alex Kokhtarov from Bloomberg Economics, thank you for joining us. Let's turn to the basic resources, the mineral side of this conversation, because Ukraine and the United States said in a joint statement that they will agree to conclude a minerals deal, quote, as soon as possible. Joining us now is Amanda van Dyke, co-founder and managing director of the Critical Minerals Hub, an industry association that works to raise awareness of the role of critical mineral supply chains in the economy. Amanda, really nice to speak to you. And we know how important these minerals are, and we know that you and many others have voiced scepticism about whether there really are such big supplies of these in Ukraine. But in terms of the critical minerals deal that's on the table, have we seen enough of the detail of it to know exactly what it contains? How much detail have we seen?
The initial details suggest that it's only a deal for new resources, so nothing Exploration development of mineral projects that are not yet in production. So everything is basically has to go through an exploration and development process, which is extremely time consuming. I think one of the things that's not being considered here is just how long it'll take and how much money it'll take to develop any potential resources that Ukraine might have.
Right, and so this is the scepticism that you and many others have voiced, that Ukraine doesn't have as much of these critical minerals as perhaps some in the Trump administration think they do. Is that the case?
Ukraine has some graphite deposits, definitely, and some titanium, which are both on the critical minerals list. But realistically speaking, when it comes to rare earths and a number of the other things on the list, they don't have real reserves. They just don't have any declared resources or reserves. And while they have indications and exploration targets, there's definitely some there. To prove them up into viable economic resources is a very time-consuming and expensive process.
So that's what I was going to ask next. You took me right there. If there is this deal to access the minerals or whatever minerals do actually exist there, what comes next? Is this a kind of resource excavation process that comes from the Ukrainians, or is this American businesses that then come and get that? How does that work?
I need to move you back. It's not a deal for access. It's a deal to go and look for and develop potential assets that they don't know exist yet. It's an exploration process. So there's no guarantee that they will find economically viable critical mineral deposits for development. Now, there is a tiny bit of fine print in the deal as it exists right now, which is it's for all minerals, not just critical minerals, all minerals. And there's definitely evidence of fossil fuels, coal, and as I said, titanium and graphite. We know those are there in some economic. Now, if they can find new ones that they can exploit, according to this deal, they could probably develop them. But there's no guarantee that they will find. You can't access something that isn't there to begin with, right? You need to find it.
No, fair point. What about things like coal, iron ore, things like that, especially at a time when we know that the global kind of steel and aluminum narrative is completely changing? Where can Ukraine fit when it comes to the iron ore deposits?
They definitely have iron ore deposits. They've been making steel utilizing both their coal and iron ore for some time. And there's a really, in mining generally and resources generally, you're much more likely to find what you've already found. So the fact that they have existing iron ore and coal deposits and a decent steel industry suggests that they might be able to, those are probably the easiest things for them to find and develop.
Where did this come from? This is the bit that I can't get my head around. The USGA has a pretty good idea of what kind of exists around the world. And as you say, you can usually find things you've already found. And I'm wondering, where did you first hear about the fact that apparently Ukraine was rich in all these critical minerals? Where did this idea come from?
It came from the Ukrainians. So there's old Soviet indications of minerals, like over 30 years old, saying that we found indicator minerals that suggest there's a potential within some of these regions to find rare earth. They never developed them. They never drilled them out. They never did the exploration required. And in the victory plan that the Ukrainians gave to the U.S. in November of last year, they suggested there were trillions of dollars of potential rare earths in Ukraine. The potential seems to have been deleted, and it's just been turned into trillions of rare earths.
Okay. So this is highly speculative.
Highly.
Okay. Let's park that bit for the moment and talk a little bit about what else is happening in the metals world right now, because I want to talk a little bit about another critical material that the world relies on, and that's copper. So we're talking a lot about what is happening with aluminium and steel right now and tariffs that are being imposed. Copper feels really critical to the electrification that we are going through at the moment. Is copper next in terms of the way we should think about the evolution of tariffs and how the world is going to become maybe more segmented in terms of the way that the copper market operates?
I personally doubt copper is going to experience tariffs because copper is genuinely rare. The amount we need of it for global electrification is huge.
Yep.
And if we put tariffs on it, it would be like cutting off our nose to spite our face. We need so much of it, adding to the cost of an already scarce mineral that the demand is growing on a daily basis, not even monthly basis.
Right.
Would be an extreme.
So the effects would be massive.
Massive. If there was tariffs on copper, the effects would be massive. It's something, yeah.
Can I just take us back momentarily, just to finish off, Amanda, take us back to the Ukraine story, just to sort of globalise it slightly, because you set something out in your notes ahead of this conversation that I found really intriguing. The existence of rare earths is one thing, but the processing of them is another, you make clear in your notes. And China, you say, does a lot of the processing. And then you suggest that perhaps there's a role for Russia in processing rare earths. Is this coming into the White House's thinking? Do we know this, or is this just the thinking within the industry, scratching around, where could this be taking us?
It's pure speculation on my part, but one of the biggest mistakes when people think about critical minerals, they immediately think about the mine, and the mine is just the first part. The processing, taking the raw ore out of the ground and turning it into a usable metal, is a much more difficult, time-consuming, multi-step process that tends to be extremely energy-intensive. Right now, 90% of the rare earths in the world are processed in China. They've built billions and billions of dollars worth of rare earth processing capacity, and it's extremely energy-intensive. One of the things Russia's got a lot of is energy. And if you do find rare earths and you want to develop and your own supply chain, you're going to have to build all that processing capacity. Also will take time and a lot of money. But like all metals, energy plays a huge role in that. So ability to access energy to process those metals is almost as important as the metals themselves.
So there is an argument you can construct, but it is all speculation at the moment, yes, that this is about the US trying to create a rival processing location to China.
Absolutely. They're looking for a different supply chain that leads to the U.S.
All right. Amanda Van Dyke walking us through those dynamics, co-founder and managing director of the Critical Minerals Hub. We thank you so much for joining the program this morning. Coming up, Puma says geopolitics, tariffs, and currency volatility will weigh on its 2025 performance. Shares called lower. This and your other stocks to watch coming up next. This is Bloomberg.
Welcome back. This is the opening trade. 15 minutes until that opening trade here in Europe. Sentiment being boosted perhaps by President Trump's narrative around growth, boosted perhaps by expectations. Maybe we creep towards some kind of peace in Ukraine. But on the other hand, the tariff threats and the earnings story not looking great. Let's get to Critty. She's got details of what has caught her eye this morning.
Well, Anna, when you're in the news flow like this and you get tariff stories coming from Canada, from China, from reciprocal tariffs out of the EU as of 46 minutes ago, you are starting to see, it's really important to see where a lot of this is concentrated. So I'm going to go piece by piece. Bear with me on the charts here. Starting with the top steel imports and where they come from. And you can see why Donald Trump's got his eye on Canada, because that is your biggest chunk of where the imports are coming from by a massive margin. And this is important because we should also mention to our global audience that the U.S. steel industry is struggling. This is why U.S. Steel looked to Nippon Steel in Japan. It's why Cleveland-Cliffs really looked to external places to really create some sort of infusion, because that's the industry Donald Trump and his administration are trying to save. They're not alone. Aluminum is crucial as well. Again, Canada, the far biggest exporter of aluminum into the United States. And you can see it by a massive margin. Your next one is only $1.1 billion coming out of the UAE. So again, this is where the pain shows up. But it's also two key raw materials that come into cars. And that's where a lot of the perhaps pain and concentration is actually kind of there. This is also important when it comes to exports to the EU, because a lot of the EU exports are coming, or actually imports from the United States are coming in the car manufacturing space alongside energy. And that's perhaps, Anna, where the reciprocal tariffs, the $26 billion, could potentially be concentrated as we're awaiting those details.
Okay, so those are some of the facts and some of the data that go behind these trade narratives that we're dealing with on a daily basis. Let's have a quick look at the euro. tomorrow because we want to reflect where we might see some response, some reaction to the latest trade narrative, 108.97, so off recent highs, down by 0.2%. Let us talk about where we are on these markets. Markets Live Executive Editor Mark Cudmore joins us on set this morning. So, Mark, the news comes thick and fast. Trump suggests he's going to put 50% tariffs on Canada, then pulls back from that as the Ontario concedes something on electricity. Then we have tariffs imposed on aluminium, steel. Europe responds. We're waiting for the big day, though, aren't we? Beginning of April. We still have all of that to come.
Yeah, I think the bigger picture narratives of the last month or two haven't changed. And I still very strongly believe this is a year where the dollar will depreciate, US markets will underperform. And I think that's the longer term narrative, and that those tariffs are going to come through and they're going to cause disruption and a kind of deglobalization trend. So I don't think that's changed. I am very curious about the short term price action at the moment, because I think the price action is very, very negative. I think risk sentiment is going to get hurt a bit more broadly. And actually, as I kind of look around this morning, if I had to look where you might see the weak hands, because it does feel at the moment that people are extremely nervous and they're trying to hold on to P&L. It does feel that we might get a bit more. I know European stock futures are up at the moment, but I think that's actually where we might see a little bit more of a drawdown in the coming days, because what's happening at the moment is this whole tariff narrative has been very much focused around Canada. But this today is the first wave of that shifting, still staying in Canada, but also shifting focus more to Europe. And I think Europe's been trading a very, very positive story, and that's maybe stretched. We've gone quite far in the euro, gone quite far in European stocks. So if I have to look for where the short-term pain might be, it might be in Europe.
We'll get a feel maybe for how Trump feels about the Europeans when the Taoiseach gathers with him in the White House a little bit later on. Be interesting to see how that one goes down. So if Europe is next, is that the catalyst? You sat down and you said the weaker hands are being cleaned down. Is that the catalyst for some of the more professional money managers to start to get a little bit more nervous? Because so far they haven't maybe exhibited the signs of pain that you would normally expect, given the scale of the drawdown that we've seen. Is there a kind of second-tier hit coming as maybe more established positions start to get washed out as well?
I definitely think there's a second tier, but I don't think it's coming yet. I think that kind of real money, kind of structural outflows in the US hasn't near started yet. I think that's like a much bigger story. And that's going to be that's the story that I think that's the next couple of years. The fact that the world is still way too overexposed to US assets at a time when the backdrop and the reasons for that are rapidly changing. And they've got to be nervous about the exposure because the rules are changing very rapidly. What happens if, for example, Trump realizes that, that foreign governments get tax-free benefits from investing in your stocks, and he goes, we want to change that? Well, then people want to cut their exposure. So there's lots of reasons that might change in the future. So I think the second tier thing is not coming in. I don't think it's coming short term. Maybe I'm wrong. But to me, that's more something to start coming, in the next kind of quarter, and it's sustained.
Yep. Where does the next leg of European growth come from? In the bull case for equities, is it the fiscal spend? Is it the Ukrainian peace dividend? Where does the next leg of growth come from?
I think it's the fiscal side is just super important in changing the narrative around Europe. I think not only is that just the G in the GDP equation of kind of the government kind of stimulus that is a directly boost GDP, but it also, I think, it's changing consumer confidence. It's changing the narrative around Europe. It's providing a little bit of pride back in kind of how the European sentiment is, and I think that's going to be the very big driver here. The European story remains a struggle, but that fiscal stimulus one's really important. As for the peace dividend, yeah, but I wouldn't want to put too much on that yet. I'm not just convinced that's going to be a major sustained driver this year.
Actually need to see whether or not we get the delivery of what is perhaps being promised and baked into these markets. Bloomberg Markets Live Executive Editor Mark Cudmore joining the program this morning. Get more analysis from him and the rest of the team. MLIV Go is a function on your terminal. From the macro to the micro, let's get our stocks to watch with Joe Easton. Joe.
Morning, Critty. So Rheinmetall reporting a big jump in orders as expected. However, given the massive rally we've seen in this stock over the past year, it's unlikely to mean further upside in the immediate term, according to analysts and market makers this morning. Potentially could see an easing off those highs. And also, we've got the headlines around the potential progress towards a ceasefire. Potentially that could even weigh on the defence sector today. So keep an eye on all of the big firms. And I've also picked out a couple of other stocks from the Ukraine and Russia region that are listed here in Europe. So Raiffeisen Bank is one for me that still has exposure to Russia, and also for Rexpo, the London-listed miner that does have exposure to Ukraine. Those could also be a couple of others in focus today. Then in terms of closing retail numbers out of Inditex, we've seen a little bit of a slowdown in sales at the Zara owner since the new year, according to their statement. And given the great run we've seen in that stock, doubling on a 3-year basis, potentially we might see a little bit of an easing in that one, according to the calls that I've seen this morning. And then over in sportswear, Puma, once again a profit warning, the second disappointment for investors this year for the German sportswear maker. They do cite some factors, including geopolitics and the trade war, but generally the sales looking pretty weak. We can see the terrible run that stock's had over the past couple of years. In terms of the analyst ratings, a lot of them just sitting on the sidelines waiting for more positive news, as we can see from this screen here. And this probably isn't going to spur any upgrades, this morning, so do keep an eye on Puma. Expected to be sharply lower for that one. Then in terms of analyst ratings, after the weekday for airlines, we've got downgrades for IAG and Lufthansa at Barclays. Those could be weaker again. Deutsche Post is a buy at Jefferies. And finally, in luxury, Brunello Cucinelli in Italy is an overweight at Morgan Stanley. Could be a positive one in Milan this morning.
Joe, thank you. Our equities reporter, Joe Easton. Another stock that's caught my eye this morning, Zealand Pharma. We could see that one up by more than 40%. And this, of course, all to do with obesity drugs. They're doing a deal, they're entering into a pact with Roche, which analysts seem to be describing in very glowing terms. Jeffrey's saying this is the best case scenario. JP Morgan saying it's very attractive. And some even saying it's really good for Roche as well. So we'll watch both of those companies at the start of trade.
Some underlying trends continue. Other trends are being completely smashed apart at the moment. Some trends are continuing that obesity story, spreading out into a wider health narrative as well, which is interesting to watch too. But the story, the takeaway to my mind this morning is not actually what's happening in the defence story, not what's happening with the Ukraine story. It's the consumer story.
Yeah.
Again, just kind of more and more evidence piling up that the consumer is nervous. You see it here in the UK. Look at what's happening with savings rates. Look at what is happening with consumer confidence here. You see it in the United States. The CPI print today is going to be absolutely critical. It's going to tell us that the consumer has been hit hard by inflation over the last few years. If that's ticking up again, how big a worry is that going to be to politics and also to markets?
And I'm not even sure if the global tariff nervousness has fed through to the average consumer yet, but we're starting to see the early signs of that with the numbers from Inditex.
This is where the expectation of price hikes, can they actually digest them on both sides of the Atlantic, are important. Futures are higher just a few minutes out from the opening trade. Stick with us. This is Bloomberg.
Is it only Wednesday? A couple of minutes to go until the start of trading. Let's talk about yesterday and figure out where it's going to take us maybe today. US markets bottomed out shortly after Europe closed yesterday. You can see the white line there. The US then rallies off that low. But if you take a look at the price action at the end of the day, really still quite negative. You had 100 stocks effectively up and 400 stocks down, so the breadth was really ugly. And some big consumer names like Delta under significant pressure yesterday. Again, coming back to this narrative that the consumer is nervous, worried, and maybe pulling back some of that spending story. We're going to see that in Europe again this morning, but maybe a more positive start here, Critty.
If you're looking for any signs of buying the dip, you're seeing them, especially in European futures, as you just laid out. Almost a 1% gain when it comes to Euro Stoxx 50 futures, driven not by what you're seeing necessarily in the DAX, but the CAC run as well. The outperformer, though, continues to be the same. That defense story in the DAX, keep an eye on those individual stocks, will be there. The FTSE 100, though, not moving to the upside by the same margin, though, Anna.
Yeah, absolutely. Let's have a look at where we are on some key sectors and stocks and where they are expected to go at the start of trade. We'll, of course, watch lots of the defence names. And one of the defence stories, we've seen numbers out of Rheinmetall. They see surging sales as Europe spends on defence. No surprise that's the narrative there. Leonardo out with numbers as well overnight, saying they see 118 billion euros of orders as Europe bets on defence. So that's certainly, and with the news out of Ukraine and the United States taking that potential deal to Russia, we will see how that plays out for markets more broadly. Puma certainly in focus, warning in terms of the first quarter EBIT. They're citing trade and FX volatility. Yes, there is also a one-time cost for efficiency efforts, but they are talking about these big global themes. And Zealand Pharma, could that be a big gainer at the open, Guy? A deal with Roche?
Absolutely. Some single stock names you definitely want to focus on this morning. Let's talk about the broader market open. It is time for the opening trade. Let's show you some numbers, give you an idea of what is going on. The tailwind coming out of America is positive. That should propel Europe along this morning. Defence sector firmly in focus as well. Keep an eye on the consumer story more broadly, though. You've got Inditex out with numbers. You've got Puma out with numbers. That is an area you want to focus your attention. The Stock 600 is up by 0.3%. The FTSE, as indicated, underperforms a little bit, only up by 0.2. The IBEX, though, is up by 0.6%. What is Inditex doing this morning? We'll find out in just a moment. The CAC is up by 0.8%. So we are seeing some positivity emerging here in Europe, but it's a big day coming up. Are we getting a reaction from the White House on what the EU has announced this morning? We heard from Ursula von der Leyen an hour ago. What is the US CPI print going to deliver? So a long way to go, but these are the early indications from a session that initially, Kriti, looks positive.
Absolutely. Green on the screen across the board, at least to your point, the early indications. We still got about 3 minutes to go before the DAX does open. Right off the bat, though, when you're looking at some of these movers, I'm not seeing a real narrative. I'm not seeing a ton of kind of outperformance in one sector over the other. 429 stocks approximately higher, 78 lower. Across the board, though, telecom seems to be your laggard this morning. You're also seeing an eye on, when you look at the sector picture, and the basic resources, I think, and construction materials seem to be the outperformer from a sectoral basis.
Yes, absolutely. I was just looking at what's driving some of those. And construction materials, we've got a real outperformance by Balfour Beatty, one of the UK listed businesses. In fact, off the earlier highs, but it has opened strongly, and they put out numbers, so that's an earnings story coming through there. Interesting, away from construction and the basic resources, which of course includes some of the metals businesses. So ArcelorMittal up by 2.4%, which I find interesting this morning, given we've seen the imposition of these tariffs from the United States on Europe, and then Europe hitting back with countervailing tariffs against the US. But a lot of the fear is, well, what does this mean for Chinese product and other product from cheaper locations in Asia? Will that find its way into Europe to compete with some of the European manufacturers? But that doesn't seem to be weighing on sentiment this morning.
It's interesting that the Chinese are telling Walmart, don't expect your suppliers here in China maybe to provide lower prices in order for you to get around the tariff story. Is that an indication that maybe the Chinese don't want to take the hit here, and they want others to take the hit? So that'll be a fascinating story. Defence stocks are down. BAE Systems, Leonardo are two big stocks that are lower. You've got Thales lower as well. I talked about earlier the fact that the defence stocks are a big driver in Europe. This morning, that's a negative momentum story rather than a positive momentum story.
The exception to that is Rheinmetall, higher by 1.4%, but really fighting the momentum on that. You bring up Walmart, though. I feel like we should take the show on the road from a Walmart, perhaps, and not just look at the China piece, but look at the American consumer piece as well. Walmart outperforms in a recession. That's the
theory.
It has in the past, at least from a stock perspective, because it's those everyday low prices, which is literally their commercial motto. So we'll see. I'm a little obsessed with Walmart.
But they've got to deliver the low prices is the point that I got to make, which is going to be the struggle if the Chinese are basically saying, don't expect us to foot the bill for that.
Absolutely. And they have an entire kind of fuel component as well, because there's gas stations across the country. So there's an energy story there as well. So plenty to watch for when it comes to that consumer story, especially on this side of the Atlantic. I'll just quickly mention here that the DAX is officially open, higher by about 0.8%. A lot of that driven by some of the defense story. We're going to let that shake out a little bit and then come back to it. In the meantime, let's bring in a true expert. Matthias, head of investments and CIO for Equities over at Berenberg, joins us around the table. You picked a great day. The markets are flying. They're very happy this morning. Is this going to last?
I would say shorter term markets could struggle a bit. Yeah. So Europe has gone a bit too far shorter term. Yeah. So the outperformance of Europe versus US was massive. One of the biggest outperformance periods, or in terms of the extent in such a short time frame ever over the last years. Yeah. So therefore, shorter term, I think markets could be struggling. And for sure, shorter term, it was a momentum sell-off in the US. So therefore, that was also beneficial for Europe. So therefore, if markets are rebounding, for sure, US will really rebound much sharper than Europe. Yeah, so the midterm picture, I would say, looks better for Europe still, from my perspective. Yeah.
You are now the second guest to talk about the medium term or the midterm as well. Let's go a little bit more short term than that. Yeah. Let's talk about 6 to 9 months down the road. When we look at a stock market sell-off, as you said, a momentum-driven sell-off perhaps in the States, it usually, at least in theory, is pricing in some sort of recession in 6 to 9 months. Is that a viable reaction? Is that fair?
I would say, first of all, the sell-off was driven by two parts. It was the tech sector in the US, which is maybe not the recession fears that were affecting the tech sector. It was DeepSeek in the first place, which was affecting the tech sector, and for sure also the tech sector was the best performer now over a long period of time. So therefore, for sure, some momentum is here going out of the sector. Secondly, recession-wise, I would say playing a correction of the economy in the US is fair. If it's a recession, to be honest, I don't know. So a correction is fair to play at the moment, and that's what markets are doing. A recession, I would say, is not priced in so far.
What is a correction of the U.S. economy as opposed to a correction of the stock market?
It's a slowdown. It's a slowdown of, let's say, the U.S. economy maybe going down slightly over the first quarter, the second quarter this year, but not dipping into a recession. And that's what we see. So also markets are in correction mode. They are not in bear market mode at the moment. So that would be the case if we are pricing in a recession for sure.
I can ask you about the global consumer, because we're looking at European markets this morning, and one of the big standout sectors to the downside is retail. And we've had numbers out of Inditex, we've had numbers out of Puma, and they both look really weak. The Puma share price down 22% at the start of trade until it was halted. Inditex looking weaker, and that's obviously a real heavyweight, the biggest listed global fashion retailer. Are we seeing something quite negative at the start of 2025 on the consumer, and will it just get worse as uncertainty continues?
Yeah, uncertainty for sure is one topic, and it's both affecting consumers in the US also. That's part of the downturn in the US, but it's also affecting European consumers. But also the stories you mentioned, like Puma and so on, are more, I would say, also stock-specific or sector-specific. So the sporting goods industry, for example, has been in a weak period for a while because of overstocking in that part of the market. And also for sure, these companies are affected potentially by tariffs in the US or tariffs of China. They are sourcing products from China, and they have a big proportion of their sales in the US, which is for sure not a good place to be in if tariffs are coming in.
Yes, and Puma citing that very thing just this morning. I suppose I wonder how much, because we're talking, yes, so that's on the cost side of things, and maybe the prices have to go up. And so it sounds as if there could be more negativity for the consumer to come. So whatever we're seeing right now, is it just the start of something?
I think it's the start of something if tariffs are coming, because then the consumer is affected much more. I would say in consumer, the safe play there at the end is luxury. It's the safest play in consumer because they are able to put through prices quite easily, usually. Hermes and other brands are easily putting through prices if tariffs are coming in. So therefore, if I would be in consumer at the moment, I still would be in luxury, in European luxury names.
If I don't have to be in equities, should I be in equities?
I think it's a good time to invest now after the correction.
Right. So you're buying the dip. You want to buy? You're happy to buy the dip?
Yes, I am. Yeah.
At these kind of levels.
Yeah.
Should I be averaging in? How should I be playing? Is this a moment that is going to exist for a while? i.e. we're going to be down here for a while? Do I have time? Is it going to be a V-shaped recovery in terms of the stock markets? How should I be? What are you thinking about in terms of what you see in front of you?
I think especially, I would say, if we look to Europe, so Europe has some upside scenarios. So the upside scenarios are fiscal stimulus in Germany.
Yep.
It's ceasefire in the Ukraine.
Yep.
It's potentially also China stimulus. And that could also serve for a good earnings recovery in Europe throughout this year or into the next year, because fiscal stimulus at the end will be not there this year. It will affect earnings maybe in 26, 27 and the economy overall. So therefore, there's a good upside scenario from all of this. And therefore, I would say Europe could outperform, as I mentioned before, more medium term, maybe not short term, because fiscal stimulus will hit the economy in 26, 27.
The tax is up in dollar terms 20%, 19% year to date.
Yeah.
Is not all of that in the price already?
Yeah, shorter term, I would say yes. Longer term, Europe and especially also Germany. Look to German mid-cap stocks, for example. They have been in a downturn for a long period of time. There have been outflows out of German stocks. They have German funds, German equity funds. There have been outflows out of European equity funds. European small-cap funds, it was one of the longest periods of outflow. So I think there's still potential in terms of positioning of investors globally that flows are coming back into Europe. and flows are coming back also into Germany after that long period of outflows. Yeah. So therefore, there is still some remaining potential over the year and into 26, 27 maybe, if fiscal stimulus and ceasefire Ukraine will be also helping markets and helping also European markets and earnings. So because there is a potential impact on earnings of, let's say, 5, 10, if not more percentage points of uplift of European earnings, and that would be the driver. Because valuation alone is not the driver, it's earnings.
It's been cheap for a while. Yeah. Cool. Nice to see you, Matthias. Thanks for joining us around the table this morning. Matthias, Head of Investments and CIO for Equities, joining us from Berenberg. Core 6 looks like this. We've seen strong performances over the last couple of days from some of the tech stocks. That continues this morning. ASML is up again. Schneider is up again. Schneider rose yesterday. Today it's up another 2%. Novo's a little bit softer this morning. You've seen the Zealand Pharma deal that we've announced, or talked about, not announced. We didn't announce it. We just brought you the news a little bit earlier on. But broadly, it looks like European equities are higher. But there's some quite significant volatility out there with a single stock name this morning. Joe Easton brings us that.
So Zealand Pharma guy, as you say, really the big mover in the market today. A massive jump for this stock. It's up 30% at the moment over in Copenhagen. Now, this is kind of one of the smaller, lesser-known obesity drug providers around the world, but it has got this big deal with Roche, potentially worth around $5 billion. Roche previously did buy another US company that was doing obesity drugs a couple of years ago, and now this looks like their second deal in the space. Zealand Pharma, their biggest gainer that we can find this morning, up around 29% now for that one. Then in terms of Puma, that one looking really, really rough at the open. It was down 22%. I saw it going into a bit of a trading halt. Does seem to be ticking now, at least it is down 22%. There we go, down at a low of 22.29 euros. Another profit warning, the second one this year, according to analysts. And then we're going to go over to Inditex, a Zara owner, not looking any more cheerful over there on that one, unfortunately. But this is a much bigger company, bear in mind, 150 billion euro market cap, one of the biggest clothing retailers in the world. So a 7% drop in Spain for Mancio Ortega's company, really hitting his wealth and that stock today. We're down 7%, the Zara owner, seeing a slowdown in sales, kind of predicted actually by analysts heading into that, and potentially more discounts over the winter period as well, hitting that one. Then in terms of shipping stocks, that one caught my eye this morning because the Houthi rebels once again threatening to resume attacks on ships, Israeli ships heading through the Red Sea, and potentially meaning there is going to be more disruption in that area. Remember, it is kind of a little bit of a perverse situation where the higher shipping rates come up because of disruption. This actually positive for shipping stocks. So we're seeing a little bit of outperformance in AP Moller-Maersk and Hapag-Lloyd following those headlines today. Then a couple of downgrades to bring you. IAG, as we mentioned earlier, and Lufthansa cut at Barclays to underweight. Barclays does cite those two profit warnings we saw from the US yesterday and the day before, Delta Airlines, American Airlines. They say there's going to be a read across from those into Europe, so they downgrade the North Atlantic exposed companies this morning. And then finally, in defence, it is a broad move lower given some of those headlines that we've seen, of course, around the ceasefire, but also Leonardo downgraded at Kepler Chevrolet today. They go to hold, previously buyers for a long time, but of course, we've had a massive rally in that stock. So Leonardo, probably one of the worst performers on defence today, down 3.6% in Milan this morning.
Joe Easton from our equities team, we thank you so much, walking us through, of course, some of those early movers that we are seeing in the European session. At the same time, we are getting some early indications when it comes to the U.S. session, at least in terms of pre-market trading, because of that change, the time change that we're seeing. A big move already when it comes to the chip sector. It looks like TSMC, these are according to just reports, not confirmed yet from these companies, TSMC reportedly proposing a joint venture with NVIDIA and some others, including AMD and Broadcom, to manage Intel's foundry operations. Now, this is a really big deal. We know Intel has had a very long turnaround story. Pat Gelsinger really trying to get some momentum into that company. Those shares higher by 7.6% off of that story. NVIDIA also higher by now 0.9%. You're seeing boosts in the numbers from Broadcom and AMD as well. Dell Technology, I want to give a little bit of love to this morning, higher by 1.2%, not because of any fundamental news, but because Mike Dell actually commented off the back of some conversations with the Trump administration, saying there are more conversations happening this this week, and specifically with Doge as well. That is your positivity this morning, those pre-market U.S. stocks. Let's talk about the negativity. Guys been talking about it all morning when it comes to Walmart and that move and that concern around what price cuts what price hikes, should actually mean, specifically when it comes to the Chinese market. Those shares down by about 0.7%, but in a broadly positive market on both sides of the Atlantic, at least in pre-market and in early signs of Europe, Walmart is the underperformer.
Coming up on the programme, we'll take a closer look at the defence sector after Ukraine accepts a US proposal for a 30-day ceasefire against Russia. Of course, this has not been put to the Russians yet. We'll see what President Putin has to say about the proposal on the table. More on that next. This is Bloomberg. Welcome back to the opening trade, Wednesday, the 12th of March. It is only Wednesday. The European equity markets are trading higher this morning, off earlier highs, perhaps a little. Novo Nordisk battling it out with Inditex to be the biggest weight in a point sense on the Stock 600 right now. Some competing narratives around where the gains in obesity are and where the weakness in the consumer is, and that's certainly one focus. So that's the overall picture then, Guy, in terms of where we are on these markets. But the defence sector, there's quite a lot happening sort of beneath the hood when it comes to defence stocks.
So what is interesting, what I think is really interesting, so Rheinmetall this morning is the one stock that stands out to the upside. So it's talking about very strong numbers going forward from here. But actually what the margin number told us was that actually there is going to be a struggle in terms of the ramp here. It's going to cost money, and that is going to be a factor that I think a lot of these defence companies are going to have to deal with. But elsewhere, you are seeing Leonardo, which just had numbers, BAE, which obviously has a huge component, obviously, in the United States as well, so you need to think about that slightly differently, and Thales, all under a little bit of pressure. So it's interesting to see what the mix looks like here this morning. But my takeaway on on Rheinmetall was fascinating, what it's saying on that story. Am I looking at the right... So Rheinmetall in and out,
yeah, but it's completely
around.
Fading its early gains. So it was fighting the curve, and now it's getting on board. Yeah,
Unch.
Unch, then positive, then down quite a lot. But if you still compare it with what else we're seeing in the space, other stocks down 2-4%, it is still flat. Flat in a market where everything else is falling feels like a win. Let's talk about the deal could be spurring some of these moves as well, which is the fact that we could potentially see a peace proposal being pushed through in Ukraine. Ukraine has accepted this 30-day truce with Russia. It comes with the idea that maybe we see a lifting of restrictions on weapon shipments and intelligence sharing. The US is now going to take the proposal to the Russian President, Vladimir Putin. Will he agree? Let's talk about the details of the deal, because that maybe gives us a good starting point. Ollie Crook joins us in Berlin. Ollie, what do we know?
Yeah, so listen, a couple of things. We should just say that this was not what the Ukrainians wanted. They've been saying repeatedly until that sort of blow up in the Oval Office that they really did not want to have any discussions about a temporary ceasefire. What they wanted to get to the table was the ultimate, lasting, just peace proposal to sign off with the support of the Americans with the Russians. That is, of course, not what materialized after that blow up in the Oval Office, and then the withdrawal of the military aid, or I should say the suspension, and of course of intelligence to the Ukrainians by the United States. That has basically forced this deal forward and into the acceptance by the Ukraine. So what it includes is a 30-day ceasefire. This is something that can be extended by mutual agreement. There's going to be some exchanges of prisoners of war. There's going to be some release of civilian detainees. This is the idea behind this, and the return of the forcibly transferred Ukrainian children. And also both sides need to now name negotiating teams to begin the negotiations for enduring peace. And this will basically now, this is if this is agreed to. What this does, though, do right now is it will resume the aid of the military aid and intelligence to Ukraine from the United States. But now, really, the situation is that the ball is in Putin's court, right? We have Steve Witkoff, who is actually the special envoy for the Middle East, but seems to be the sort of broker for ceasefire and peace deals. He's going to head to Moscow this week, and this is going to be now a discussion for the Russians. What was interesting that we heard from Marco Rubio after these talks in Saudi Arabia is basically everybody saying that they hope that the Russians will sign the deal, and that if they don't, we'll know what the impediment to peace is. That prompts the sort of major question from the Trump side, which is what is the Trump administration willing to do if the the Russians do not want to come to the negotiating table. We've heard about potentially augmenting sanctions on the financial sector, fossil fuels, that sort of thing. Could they flood Ukraine with more weapons? But again, this is a United States that wants to have less involvement with Ukraine rather than more. So it's hard to know exactly what the Trump administration would be willing to do if indeed the Russians do not want to come to the negotiating table and sign this 30-day ceasefire agreement.
Yeah, really fascinating to see how much of the US conversation with Russia is about Ukraine and how much it is about other areas, other spheres of potential cooperation or other reduced impediments to Russia. Let's talk about the earnings story and the defence companies in Europe then, Ollie, because we had numbers out from Rheinmetall earlier this morning. That stock was doing OK in the early part of the trading day, paring those gains a little. How do we factor European defence spending then into what happens next in Ukraine? Because on the one hand, there's been a sort of short-term need to spend more, and then there's the longer-term need to spend more.
Yeah, so listen, I wonder how much of the sell-off we're seeing across the defense sector is potentially about, the potential incremental step towards peace. I think it'd be hard to say. We'll give it a little bit of time to wash through. But let's just look at what we got from Rheinmetall, right? Talking about their sales estimates for 2025, looking at the year ahead. When we've spoken to a lot of the defense companies that we've spoken to over the last, couple of months, they basically forecast 10% growth annually kind of for the foreseeable future. Rheinmetall is talking about 25 to 30% growth for 2025. They're looking at margins at 15.5%. We should say that's a little shy of what the analysts were hoping for this year. They were looking for something just north of 16%, but still 15.5% is more than they delivered last year. And you have this record backlog, and this speaks to one of the main issues within European defense. 55 billion euros, a record backlog for Rheinmetall. It is the difference between the order books that are coming in and the ability to actually get this hardware out to the clients, and that is sort of going to be the big story of the ramp up over the next couple of months and really years.
Bloomberg's Oliver Crook there walking us through the latest developments when it comes to Ukraine, but also the latest developments when it comes to that defense spending. Now, that's just one piece of the equation that Europe has to deal with in terms of an inflationary impulse. The other piece is, of course, the tariff story. Now, the European Commission has launched, quote, swift and proportionate countermeasures to new U.S. metals tariffs worth up to 26 billion euros. Adoption of the tariffs due in mid-April. EU Commission President Ursula von der Leyen saying she remains open to negotiations with the U.S.
Our countermeasures will be introduced in 2 steps, starting with April 1st and fully in place as of April 13th. In the meantime, we will always remain open to negotiations. We firmly believe that in a world fraught with geo-economic and political uncertainties, it is not in our common interest to burden our economies with such tariffs.
Let's break down the details here. Bloomberg's Brendan Murray, who leads our global trade coverage, joins us around the table. 26 billion euros on what?
Yeah, we don't know the list exactly yet, but it will be commensurate with what the U.S. is punishing Europe with regarding the steel and aluminum tariffs. The Rubicon that's been crossed here today is we now have a global trade war. It involves the major economic engines all over the globe, Europe, North America, and the big exporting powers in Asia, in China, Japan, South Korea. So what we've seen is a different response today. Some countries, like the economy, like the European Union, are saying, here's what we're going to retaliate. Here are the dates. Let's sit down at the negotiating table, or these are going to take effect. There's been a more measured approach taken by Japan, South Korea, Australia, and even the UK to say, why don't we just not threaten things right now and let's sit down at the negotiating table? We've seen this kind of hardball tactic that Canada played over the past few days versus the more measured approach that Mexico takes. So I think we're seeing 2 different approaches to dealing with Donald Trump. And who knows who's going to come out on top, but he's shown he could escalate and de-escalate the threats that he's making.
And interesting that we've seen no exemptions despite pleading by various countries. No late exemptions, just briefly, Brendan.
Exactly.
Yeah. OK, Brendan Murray, Bloomberg's Brendan Murray with the latest on the tariff story. We continue to watch that. We were hearing there from Ursula von der Leyen about the 2-stage approach that Europe is going to introduce. And, of course, we're still working our way towards those wider tariffs away from just aluminium and steel to a wider suite of products that the Trump administration has promised. We will think about what the tariff impact is having on small businesses. Coming up, we'll talk to the Sage Group CEO, who joins us on set next. This is Bloomberg.
This is the opening trade. About 30 minutes into today's session, seeing green on the screen across the board, but outperformance as usual. I'm almost getting a little tired of saying it over in the DAX. Also seeing the French index catch up as well. Both indexes higher by 0.7%. Your notable laggard in Europe this morning, although still in the green, higher by 0.2% on the FTSE 100. This feels like the buy the dip moment, Guy, when it comes to equity indices on both sides of the world, despite getting not so great data over in the States when it comes to small business optimism.
Is it by the dip? The gap higher this morning is pretty small.
We went from red to green.
European stocks on a 3-day basis, Monday, Tuesday, Wednesday, are still down by 2.5%. Are we going to see a sustainable bounce? We bounced a little bit, but we're now kind of going sideways. I think we're looking for the next catalyst to come through in the form of US data. We're going to get CPI a little bit later on. The data we got yesterday I thought was really interesting in terms of the NFIB data. Got that right? And I think two takeaways from that, one of which is they're still trying to push prices through, which I think is interesting on the inflationary front, taking us to the CPI number. But there's caution out there, and it's growing. And normally, I think what the expectation was that small businesses would benefit from tax cuts. They did last time around. Trump 1.0, small businesses in the States did really well off the tax cuts that came through early on.
Yes.
And you had that kind of burst of enthusiasm. Small businesses are highly sensitive to that, it seems, in the States right now. It's not coming, and as a result of which that's started to show up in a bit of a more cautious
And President
approach.
Trump was pushing that with big businesses, with Wall Street, just yesterday when he talked to them. But from the NFIB, the thing that stood out for me was the CapEx number, CapEx plans at a 5-year low. And that's the kind of uncertainty that weighs, of course. That takes us nicely into our next conversation. Economic uncertainty is also impacting UK small businesses. New data from the FTSE 100 software company Sage Group reveals firms are strengthening their financial positions amid declining profit and productivity. This ahead of planned tax and minimum wage hikes that are coming next month. The Sage Group CEO, Steve Hare, joins us around the table to discuss this and many other things. Steve, very good to see you. Thank you for taking the trip down to come and see us. So we'll start on the UK because you've got this interesting tracker out, but of course half your business is over in the US, isn't it? So you can definitely speak to that theme as well. Let me ask you about small businesses in the UK. Your research is for the fourth quarter, so we're looking at how businesses are positioning for the impact of the budget, I suppose. And you see nervousness there. Before we even factor in any sort of tariff story, you see a bit of nervousness, but businesses are protecting themselves. What's the takeaway?
Yeah, I think the starting point is that small, mid-sized businesses, they have a bias for optimism. So they're running their own businesses, they're trying to grow their own businesses, and they tend to focus on what they can control within their own environment. So that makes them optimistic. The flip side, as you say, though, is they can see cost pressures coming. That makes them more cautious. I think the noise, the uncertainty that we're seeing in the world, whether the UK, US or anywhere else, it tends to make people cautious, which means that they hold back. So you can see in our survey data that people are holding more cash. If you like, they're waiting, and if they get the right environment, they'll invest. But at the moment, they're being cautious.
Yes, and waiting seems to be the theme of that NFIB survey from yesterday. Last time we spoke to you, Steve, over satellite link was November, and we just had some NFIB data then as well, and it showed that optimism about tax cuts that Guy was referencing. This time around, you don't see that optimism. You see nervousness. You see holding back on CapEx. Is that what you're seeing then in your clients?
Yeah, so we are seeing a bit of that. I think it's the same thing. People they're ready. They have the capacity and the capability. And, with tax cuts, there's the available capital in the US to spend them with small, mid-sized businesses. But because it's a noisy environment, because they're a bit unsure, are we going to get inflation? Am I going to have more headwinds? It tends just to make people a little bit more cautious. So if you ask them, how do you feel about the next 12, 18 months? They'll tell you they're very optimistic. But then in the short term, there's just a little bit of hesitancy.
Does that mean they don't employ people?
I think Actually, there's two sides to that. One is, depending on which market you're in, there's also still skill shortages. So, when I talk to, businesses, for example, here in the UK, small business owners, which I do all the time, say plumbers, electricians, etc., they often talk about how hard it is to find the right skills to create the capacity. I mean, actually, if you talk to plumbers and electricians, they're not short of work. There's plenty of activity going on, but they need to create more capacity.
Does that mean they can push through? Let's look at it from a different angle. If there's lots of work and there's not enough supply, that usually implies price rises.
Yeah, I think the risk, again, it's, people are nervous about inflation. I think if you ask small business owners, they're looking forward, they're looking at their cost structures, they're worried about inflation. And at the same time, they're looking at, well, depending on which sector I'm in, how much can I push price through to my customers?
That's on the consumer side. What about kind of on the supply chain side? When it comes to purchasing power, it feels like so many of the large businesses are sitting on piles and piles of cash to be able to navigate that. Small businesses not so lucky. How do you navigate this environment with less purchasing power? Yeah,
so I think small businesses are sitting on more cash now, so they're kind of preparing for any eventuality. They also, when it comes to supply chain, depending on what industry they're in, there's a lot of local, people buy from each other. They buy from local businesses. They buy from other small businesses. So this is kind of a bit of a circular thing, right? If everyone's pushing price, we're going to see inflationary pressures. But at the same time, people are also focused on efficiency. So with the latest technology, investing in things like AI, etc., you can also drive your own efficiency and productivity.
So Larry Fink very famously came out early on out of BlackRock and said that if you're concerned about wages, you're concerned about labor shortages, for example, AI is the solution to all of that. Are you seeing that kind of adoption process, that replacement of labor, insulate small businesses from those risks? Yeah, we're starting to see more take-up of AI, led by the US. There's more take-up. The US tends to be early adopters of new technology. But what we're seeing is really small businesses, the human is still at the center of everything that's going on. So what they're doing is they're using AI to automate tasks, to increase the effectiveness and efficiency of both themselves and the people they employ. So to some degree, it's countering the skills shortage. It's not really replacing jobs, because at the moment in the US, the UK, South Africa, where I was a couple of weeks ago, actually what you're seeing is this focus on increasing capacity. And AI is contributing to that.
Yeah, thinking about the UK's ambitions on AI, Steve, where do you think the UK should pitch itself? Because I remember a time when we were trying to create Silicon Valley along the M4 corridor west of London, and then we tried to create Silicon Valley, in inverted commas, in the Silicon Fens between Oxford and Cambridge. What should be the extent of the UK's ambitions on this front, realistically?
I think what we're very good at is applying the technology. So we don't need to compete with the big technology companies who are spending billions of dollars, creating the large language models. I think what we need to do is focus on, well, what are we good at? So in our case, we're focused on how can we help small, mid-sized businesses with their accounting, their payroll, their HR, etc. And so how can we leverage off those big models, those big large language models, but create domain-specific capability which allows us to then automate for our customers. So it's kind of real solutions for real situations, as opposed to this kind of more grand vision of, having these agents that sort of become your companions. This is about automating stuff that matters to you every day.
Steve, you've been down for a few days in Newcastle. The government's getting ready for a budget. I'm sure they're listening to people like you. Your advice is valuable. What is your advice right now? What do you want to see from the budget? What's the message to government? It's been a confused, difficult message for business thus far from government. Do you expect clarity? What are the key things you're looking for?
Yeah, so the key thing I'm saying when I get the opportunity is exactly that. It's you need to have clarity. You need to have consistency. To some degree, we've had our big budget, and it doesn't matter whether you liked it or you didn't like it, right? Yep. Politicians face tough choices. What we need now, though, is we need to get rid of the speculation that there's more to come, so that people can plan, they can invest through the cycle without worrying whether there's going to be some more tax rises or there's going to be uncertainty.
And the feedback you're getting is?
They understand that, but obviously they still have some challenges in terms of balancing the books. So, they've got to look at the expenditure side, which they are doing in terms of public expenditure. And in the end, the economy's got to grow.
It does. Let's hope it does. That would certainly make balancing the books a lot easier.
It would.
Steve, great to see you. Thanks for dropping by to see us. We really appreciate it. Steve Hare, the CEO of Sage Group. Coming up, we're going to cross to Frankfurt. ECB President Christine Lagarde will give her opening comments from the ECB Watchers Conference. We will bring them to you live. That is coming up. This is Bloomberg. Wednesday morning, 43 minutes into the equity market session. This is the picture. We are up but down. European equities this morning, let's call it up circa 0.75%. On the week, we are still negative. There is a small gap higher this morning that is taking us to the kind of numbers that you're seeing on the screen at the moment. The story, I think the takeaway, though, this morning is one of consumer weakness. That is showing up throughout the equity story. Take a look at what is happening with stocks like Inditex, big heavyweight stocks that we are so focused on right now. That is where the weakness is coming through, and I think that is significant.
Certainly something that we're going to keep a very, very close eye on. In the meantime, as we've been speaking, we've gotten headlines coming out of an EU official, actually, talking about that the EU is going to be targeting GOP-led states with retaliatory tariffs. This is according to one official, also saying that the EU tariff retaliation will include the House Speaker Johnson's state. That is the home state of Louisiana, I'm being told. GOP-led states have major exports to the EU in two key areas: energy, oil and natural gas, and agriculture. So it kind of feels like agriculture, which has been a sticking point between the U.S. and the EU for quite some time, may be where the pain lies.
Yeah, I mean, very different regulatory environments that have been fully entrenched for a very long time. I mean, maybe that shifts at the margin, we'll see, but very different backstories there. In terms of energy, the Europeans have offered to buy more LNG from the United States and buy a lot of it already.
Europe needs to buy a lot more energy from the United States, and obviously that comes out through Louisiana in one of the key areas. That's where a lot of the trains are in terms of the gasification that it's become a key area for. So, it's hard to see that being the target. I wonder what effect that will have. Does that, though, is there a danger that that strategy backfires? That ultimately this just reinforces the idea that Trump and the GOP feel that they need to do more on this. And it may be, and the lesson from Canada over the last few days has been, you hit us, we're going to hit you back twice as hard. Is that maybe the response that we get out of the Trump administration, out of the Republican Party?
It seems almost it's dangerous if you push back hard and dangerous if you don't fight back. It seems as if you can craft both narratives. And let's have a look at some headlines dropping across the Bloomberg terminal. We are waiting to hear from Christine Lagarde. She's going to be speaking at the ECB and its Watchers Conference. A few lines from her prepared remarks have already dropped onto the Bloomberg terminal, so worth just going through those. Central bankers will need to show agility. Well, that certainly seems sensible. Maintaining stability will be a formidable task. And she goes on to say that the era of shocks makes the ECB's inflation job harder. So these are the early lines coming through from Christine Lagarde.
Does that sound hawkish to you? Shocks are shocks. In some ways, the tariff shocks are going to be inflationary. Is she basically signalling maybe a more hawkish stance? Certainly we're going to sit on our hands and do less stance, maybe. You could maybe take that as a given. It's a more difficult task. Maybe the difficulty is going to be sitting back and doing nothing. That can often be a challenge. But in some ways, that sounds tougher to me. And I'm wondering if that's a slightly hawkish tone being delivered by Christine Lagarde.
Yeah, perhaps. And as we await those official comments from Christine Lagarde and waiting for her to speak, we are suddenly getting comments from ECB's Simkis as well, saying a lot of what you just said, actually, which is the direction of travel hasn't changed. It's irrational to commit on future rate decisions. But ultimately, the question I think everyone's asking, is it a cut or a pause in April? And does a pause signal a change in pattern for the next few months?
Well, maybe that's what agility goes to, this not wanting to pre-commit. I mean, central bankers don't ever want to pre-commit too much, or maybe they do sometimes, but not often they don't, and they want to be data dependent and all that good stuff. But wanting to be agile, to be able to be agile in the face of things that will come at you that you don't even know about yet might be important for 2025.
Does agility imply doing something? Or does it... is sitting there doing nothing...
Is that agile?
Is that agile?
Yeah.
I don't know. Because that's maybe the question we're going into. Are we going into a period where the ECB does nothing for a while and waits and sees?
Well, if it changes in financial conditions, then doing nothing can be doing something.
Well, the other piece that we haven't even talked about is this is all the rate cut story. What about QT? What about the higher yields in bonds? I mean, the surge that you've seen in the bond market, already you've seen tighter financial conditions. So the case for a cut is to combat the markets already kind of tightening, right?
Maybe. How do we fold in the fiscal? How does she think about the fiscal? How does the ECB's Governing Council think about the fiscal impulse that is coming? Again, really hard to tell. We don't know the details yet.
Yeah.
How quickly is it going to come? How quickly is Germany going to spend money? What's the trickle-down effect of all
economy,
of that?
yeah.
So many unknowns at the moment.
And we're talking in Germany, just in Germany, about a policy that takes on infrastructure and also takes on military spend. And the multiplier effect on the German economy of those things will be really different. And I was reading some research yesterday that suggested even the infrastructure spend takes time to deliver, and therefore the multiplier is sort of delayed. And then you look at what happens with the defence spend. Well, that's a lot less clear. Although we did get some headlines yesterday from European voices suggesting that money should be spent in Europe. But, to what extent is that going to be possible?
But that's hard.
Yeah.
There isn't the capacity to spend that money in Europe at the moment.
Well, how many times have we heard of folks coming up on our very own show and saying, you can spend all the defense, but there is still a massive leak to the United States? I think Sharon Bell over at Goldman Sachs said something like 70 to 80% of that defense spend goes straight to the American defense makers, right?
There's a component parts story to that as well. You think about a helicopter or an aeroplane or a tank or whatever. There are all kinds of different subcomponent supplies that go into that. Are they all from Europe? Do they all come from this region? Does some of that technology come from the United States? A lot of these big defence companies are relatively global in terms of their footprint, and US companies operate in Europe to a huge degree as well. So trying to define what is European and what is American-made is also really, really difficult. And trying to get an understanding of that, you almost have to go kind of line by line in terms of understanding the products that we're buying and what we're going to need in terms of the capability.
Well, the one thing that we haven't even, it feels like has completely slipped everyone's mind is the deficit story. Mm-hmm. What happened to surging yields in France and this kind of spread widening in Italy, this prep spread closing in Spain, arguably in the U.S. as well, where you have this deficit concern on July. I think we heard overnight that the House has now passed a budget, so we're kicking the can down the road again on a shutdown. Does the markets not care? Do the markets not care about the concerns around the deficits that I think have been plaguing these markets for the last 6 months? Let's
talk about inflation. We're going to get CPI data out of the United States a little bit later on. That is going to be a key moment. Is inflation proving to be stickier than we anticipated? Certainly that is the expected narrative coming out of the States. To a certain extent, it's the narrative here in Europe as well. Yeah, we're going to be looking for that CPI data out of the United States to take a step down, aren't we? Even if we're still worried about whether it pushes up again because of the tariff threat. We are still waiting for Christine Lagarde to speak, we should just point out. She's being introduced at length with a conversation about the German economy. And we've seen such big shifts in the German economy and the fiscal expectations out of Germany. Of course, that it's entirely understandable that we're watching that conversation develop in Frankfurt as we wait for Christine Lagarde. Taking a breath from the Christine Lagarde watch, and we're waiting for her to speak, as I say. Valerie joins us on set. We are waiting for CPI out of the United States, Val, so maybe give us a heads up as to what you're watching for on that front.
Yeah, look, any confirmation that last month's print of a 0.4 reading on core CPI is going to be declining today. The Wall Street consensus expectations is that it will drop down to 0.3%, but we really need to get back to the 0.2 and 0.1 month on month for the Fed to be confident that inflation is on the right track. The Fed is in the blackout period ahead of their meeting in 2 weeks' time. A lot of the focus recently now is on the May meeting when it comes to the Federal Reserve. Are they going to want to keep that open just in case they want to do a cut in that May meeting and the first week of May? It was just yesterday that we saw the odds for a cut in the May meeting hit 50%. They've since retraced a little bit as the equity market has come back a bit, but that May meeting is going to be on focus and whether they want to keep that alive.
We kind of feel like we're caught between the devil and the deep blue sea when it comes to inflation in the States, though. If you get a softer print, people are going to talk about recession. If you get a hotter print, people are going to talk about stagflation. That seems to be... those are the options right now.
Look, we should just say that we've never actually seen the U.S. enter into a recession just based on policy uncertainty.
Okay. Valerie, thank you very much. Valerie Teisel with us to talk about the markets. Let's get back to Frankfurt. Christine Lagarde speaking at the ECB and its Watchers Conference.
Within the Eurosystem, we feel very strongly. Good morning to all of you. everything is okay, you've settled, you've managed to arrive despite the traffic, despite this slow-going move that has nothing to do with the move that we are observing at the moment in Europe. And this is something that we should be, I'm certainly, excited about. So let me start with a quote by someone that some of you might know. He's French. And some of you might think of Victor Hugo as a big proponent of Europe, Monet and Schumann and many others. Paul Valéry was a great supporter of Europe as well. And he wrote the following: "The trouble with our times is that the future is not what it used to be." He was copied many times by others, and that quote is attributed to other people, but it's him who started with it. And I think it's particularly fitting for the times, because our expectations have indeed been swept aside in the last few years, let alone the last few weeks. Established certainties about the international order have been upended. Some alliances have become strained, while others have drawn closer. We have seen political decisions that would have been just unthinkable a few years ago, a few months ago, a few weeks ago, just to see them overturned the following day. So the level of uncertainty we are facing is exceptionally high. An index of trade policy uncertainty currently stands at close to 350, which is more than 6 times its average value since 2021. And indicators of geopolitical risk stand at levels not seen since the Cold War, except for times of war and terrorism. This new environment raises fundamental questions for monetary policy. How can we deliver price stability in a new geopolitical era? As you said, Professor, our strategy assessment is ongoing under the leadership of Philip Lane, our chief economist, and brings together all Eurosystem experts in these fields. So I'm not going to cover every issue that they are currently discussing. This would not pay tribute to the work that is ongoing. But I will focus on the factors that I consider to be particularly relevant in this new era. And I will ask 3 questions, so bear with me. First, how is the environment in which we operate changing? Second, what do these changes imply for our reaction function? And third, what do those changes imply for our policy communication? My main message, and I will develop that and argue, is that in an environment of uncertainty, a strong commitment to maintaining price stability over the medium term is more important than ever. This commitment will require agility to respond to new shocks, but within a well-defined framework that limits short-sighted reactions and unbridled discretion. As a result, we will need to continue steering the public's expectations. People interested in us will be looking to us, and other policymakers, of course, to understand how we will navigate this more volatile era and help reduce rather than amplify uncertainty. So, is it just agility? No, it's agility combined with clarity. Even if we cannot provide certainty about the rate path, we can provide clarity about our reaction function. So let me go to those 3 questions that I have mentioned and look first of all at the environment. When we last reviewed our strategy...
ECB President Christine Lagarde speaking at the Watchers Conference in Frankfurt. If you would like to continue to follow her remarks, you can do so on the Bloomberg terminal. Live Go is the function you want to be using. That is it for the opening trade. Up next, Danny Berger counting you down to the US Open. Futures are positive. This is Bloomberg.